Yes. Okay. So normally it will be recorded. There is no reason why it wouldn't work. So just a very last attempt to share my screen. So everything is working. Perfect. So we're going to start immediately, even if I can see that everybody hasn't joined yet, but the time to open the file and explain why it's different from the one you have seen last time, I think the others will arrive. You probably remember that last time, I mean 2 days ago or 3 days ago, last Monday, we're already on Thursday, so 3 days ago, I explained the way to value a bank. And we've taken an example regarding the French Société Générale group. I didn't change any calculation we've done together, but I have added other sheets in order to perform additional calculation we will do together today. So I mean that regarding what we've done together, there is absolutely no change, but I have added two sheets, one for M&A transactions, which we will perform later today, and another one regarding a French global insurance company, the name of which is AXA. I added a sheet on AXA just in order to explain that the way to value an insurance company is more or less the same as the one to value a bank. This is what I will explain. But regarding the calculation, it's unchanged, of course. There is no reason why anything would change, keeping in mind that I had no reason to change the business plan. So this is what I wanted to tell you. I also have to say that inside the system of Canva, firstly, I uploaded the same file with the same name with another with additional sheets, as I just said, and then I said it's better if I change the name, so I changed the name. It is evaluation of a bank number 2, and I didn't get rid of the previous one, but there are the two same ones. So I'm going to open that immediately. You see, we had DDM valuation of a bank and DDM valuation of a bank V2, and I will focus on this one. And if I go to the sheet BP, you normally recognize what's been done last Monday without any change. So again, changes correspond to the addition of M&A updated data and AXA. That's it. But regarding the BP we are dealing with, I will terminate that today, there is no change. So what did I explain last time, just to have a kind of wrap-up, if I may say? I explained that if we want to value a bank, I could say a financial institution, because what I've explained is also valid for other regulated financial institutions. You need to include the solvency constraint in the valuation process. I mean that you can have a listed peers approach and then focus on the book value and the tangible book value. You can have M&A peers approach, but if you have the information and when there is an M&A deal, you necessarily have the information, the best thing to do is to prepare a DDM, dividend discount model, based on a business plan. So if you look at what you have on your screen, you probably remember what we did. We had in green some forecasts till 2024 for some P&L aggregates. I mean that we have some forecasts till 2024 for the net banking income. We have some forecasts for the gross operating income, And for the earnings before tax, I could also say, but we've not used that yet, it will be the case in the coming minutes, of course. We also have some information regarding the net income group share. And that's it regarding the forecasts. The forecasts I've taken into account are provided by Capital IQ, which is a reliable source investment bankers are sometimes using, whereas they normally prefer to use FactSet or Bloomberg. But we can, without any hesitation, use the FactSet forecasts. It's the first point. The second point I would like to say is that all the information we have here corresponds to financial data which were available just before the war in Ukraine. So why did I choose that? It's not because it's an exceptional situation. Of course, it is an exceptional situation. But for Société Générale, I have to say that it's a dramatic situation. I mean that Société Générale was active in Russia till the beginning of the war. I mean that a part of its activity was relying on Rosbank, which was historically incorporated in Russia. So, first of all, it's been imagined that most of the receivables would have to be written off. And at the end of the day, what happened was that they got to sell, Société Générale got to sell its Rosbank subsidiary to the shareholder which had sold to Société Générale this bank in the past. And of course, it's a Russian shareholder, which is probably near from the government and of course, from Vladimir Putin. So what I want to say is that, of course, it's an exceptional situation. And Société Générale did not disclose a lot of information when it decided to sell its subsidiary in Russia, which means that in spite of the disclosure, which is officially available, we can't reconcile the balance sheet information based on that. We need that Société Générale publishes its accounts for 2022, or at least its half results, which will not occur before end of August or beginning of September. So this is why I provided a consistent set of information with financial data just before the war regarding the income statement, but also regarding the market risk premium on the one end and the risk-free rate on the other end. So everything is consistent and will have to be compared to the market cap of Société Générale just before the war. However, when we deal with M&A later today, probably, we will use updated data. But for that, it's better to be just before the war. So first point, we had some forecast in 2024 in green. Second point, we need to keep in mind that the data date back February 2022. And there is, as usual, for any firm, it can be a financial institution, it can be a corporate entity. We have an issue, which is that for the year 2024, the last year of the brokers' forecast, we have a huge growth rate, 4.9%. And I know that in Europe and in the US, we are experiencing a huge inflation, We've been experiencing that since the beginning of the war, even if inflation had started before the war, but of course, war has increased the pace of inflation. And as you probably know, central banks are doing their duties, which are not very favorable for the stock exchanges, in order to reduce inflation. And you probably know that Jerome Powell for the US announced a 0.75% hike regarding the reference rate in the US. And we know that in Europe, even if Christine Lagarde has said many times the contrary along the past 6 or 9 months, it's now obvious that the ECB will increase also the reference rate. So what I mean is that, yes, we are experiencing inflation, but we can say that 4.9% growth rate, as you can see for the net banking income in 2024, is a recurring growth rate. I mean that it may be the case in Asia. I mean that for China, for example, it would be a ridiculous growth rate because they are used to having higher growth rates. But for Europe, it's too high. I mean that the highest perpetuity growth rate we can take into account, the highest long-term growth rate we can take into account in Europe is 3%. And I can tell you that before the two crises we've been experiencing in the world for about 2.5 years, namely the COVID crisis and then the war in Ukraine, the perpetuity growth rate, the long-term growth rate regarding GDP, regarding firms' growth, was more between 1.5 and 2% than 3%, which means that 3% is already a bit optimistic. But as we are experiencing inflation, we can take 3%, not more. So having said that, we have some forecast in 2024. We take an assumption of 3%, which is more conservative than 4.9%. And what we've done last time together was a soft landing of the business plan and therefore a soft landing of the growth rate between 4.9% in 2024 and 3% in 2027. And you can see that I have entered here the formula for the soft landing of this growth rate. And once we have the growth rate for every year, if we know the net banking income of the previous year, we can simply apply the growth rate as we've done. We also add some gross operating income. For example, in 2024, it's supposed to be 10,193 million, which means 10.2 billion euros. And we know that in between, I mean between the net banking income and the gross operating income, you have the operating costs, which have been calculated as the difference between the net banking income on the one hand and the gross operating income on the other hand. I know that I entered the opposite just in order to sign negatively the operating cost without having to open and close brackets. We also add some information regarding net income from investments, net income from others, goodwill adjustments. We said that these figures, which are relatively low compared to the other amounts you have above, would be flat in the future. And as we had some forecasts regarding the earnings before tax or pre-tax profit, you name it as you want, we got to reconcile the operating income. And we know that between the gross operating income and the operating income, we have just in between the cost of risk, which is the difference between the gross operating income and the operating income. And again, as I wanted to sign negatively the cost of risk, without having to open and close brackets, I calculated that by the difference between operating income and gross operating income. This enabled me to calculate the cost of risk as a percentage of the risk-weighted assets. And of course, in order to calculate this percentage, I needed the risk-weighted assets. I have to remind you that we had the risk-weighted assets in the annual report of Société Générale only for the past, namely for 2020 and 2021. For 2021, it's supposed to be 363 billion. Okay, where does it come from? It comes from this table. Where are the risk-weighted assets? Risk-weighted assets, 363 billion. And for the previous year, as you can see, it was 352. You can find also here. And then in order to go on, I mean, beyond 2021, I decided, as brokers and investment bankers are used to doing, that the growth rate of the risk-weighted assets would be equal to that of the net banking income. So you can see that at the end you have 3% here, and amazingly, for the last year here you also have 3%. So in fact, as we had some forecasts regarding the risk-weighted assets, we could calculate here the ratio between the cost of risk. I entered minus because I didn't want to see a negative ratio, divided by the risk-weighted assets, keeping in mind that when we speak about the risk-weighted assets, we are in billion euros, whereas for the income statement, we are in million euros. And in order to be consistent, I multiply by 1,000 the denominator corresponding to the risk-weighted assets. And once I had calculated the ratio between the cost of risk and the risk-weighted assets, which was 0.7%, I assume that this could be taken into account for the next year. And I mean that from 2025 onwards, it would be equal to what we had at the end of the previous year, namely 0.7%. And that way, we got the cost of risk. I mean that for every year for beyond 2024, I mean from 2025 onwards, we knew that the cost of risk was 0.7% of the risk-weighted assets. So if we wanted to have the cost of risk, we simply had to multiply the 0.7% by the risk-weighted assets and to multiply by 1,000, because here we are in billion euros, whereas we are waiting here on the line number 8 for a cost of risk in million euros. And this is what we've done. So I would like to know, before going on, I'm going to check the chat, whether you have question on that, or if it's okay, and if we can go on. No question? Can I now terminate the modeling regarding the business plan of Société Générale, or are there some points which have not been understood so far? It's okay? Please don't hesitate. No, it's okay? There seems to be no question, so I'm going to go on. And I will come back in 5 minutes here just to check that there is no question. But you can ask your questions directly without typing them. Of course, you can speak. It's more comfortable, probably for everybody. So what I want to say is that the operating income we have here is by definition gross operating income minus cost of risk. We have the gross operating income. We have the cost of risk. So gross operating income minus cost of risk. I said minus and I am typing plus because, as you know, I'm used to signing negatively all expense and also all cash outflow. It's not a cash outflow, the cost of risk, but I'm also signing negatively the cash outflows. So, I mean, I just have to add. And of course, what I've done in 2025 in terms of formula can be extended beyond, namely till 2027. So we have the operating income, we have the various miscellaneous aggregates below, net income from investments, net income from others, goodwill adjustment in the background of impairment tests. So at the end of the day, we can easily add everything algebraically to have the earnings before tax. I would just like to say something because I do not know the Vietnamese GAAP, but I would just like to tell you that in many countries, you now have the IFRS rules. And when you use IFRS rules, when you have a goodwill, you put it on the asset side. And every year, you have to wonder whether this asset is still justified in the balance sheet. Which means that the goodwill, I will come back on that later today when we deal with M&A transactions. The goodwill is the additional price which is paid by the buyer beyond the book value of equity of the target. And if it is still justified in the future, you do not have to depreciate. You do not have to amortize. You do not have to impair, as we should say, the goodwill. But sometimes the firms realize that they have overpaid the target. The price was too high, and therefore the goodwill was too high. And for that reason, part of the goodwill, sometimes the whole goodwill, has to be impaired, has to be reduced on the asset side. So it has been about 100, 114 in 2021. There is no reason why it should be meaningfully different in the future, except, of course, because the future now it's the past for 2020, but it was the year of the COVID. So I'm going to say, let's add algebraically the operating income and the miscellaneous aggregates. So I'm calculating the sum, you can see, between all these amounts, just in order to have the earnings before tax, which means that we are not very far from the bottom line of the income statement. So I have the sum, as you can see, and of course I can extend the formula. As you can see, I am saving as often as possible so that there is no problem. So we have the earnings before tax till 2027. Then we have the income tax. Yes, we have the income tax. We have the income tax, which is calculated based on the earnings before tax and based on a corporate tax rate. And of course, we are going to calculate this corporate tax rate for the group. You can see that we have here the net income group share. It means that there is a consolidated net income, and I could say of which net income group share, of which group share, it's enough, and of which minority interests. Happen that all the information we are using here is based on a consensus of brokers, which is published by Capital IQ. And you can check, you have the model on your laptops, but you can trust me, this breakdown does not exist in what I've sent and what exists. We only have the consolidated net income group share. So we need, of course, the total consolidated net income because it's based on that we are going to calculate the corporate tax rate. So for 2021, okay, it would be better if you could see for a few seconds again the years. Okay, normally I can extend till here. And we are going to check, okay, consolidated net income group share in 2021. Okay, you can see net income group share 5,641. Okay, this is exactly what's coming from the previous sheet. I mean the consensus which is there, which means I had checked it before, of course, that Capital IQ has done the job properly. Needs to be consistent with the past. For the past, we also know that there are some minority interests. Now, personally, I'm used to saying minority interests. Many groups also say minority interests, but some of them, it's exactly the same as Société Générale are saying non-controlling interests. Why not? Okay, so 697. Okay, so I'm going to enter it, 697. And just a second, because you can imagine that it's not. Voilà. And for the previous year, 400 non-controlling interest, as you can see, 454. 454, which means that the consolidated net income is the sum of the group share and the minority interests. You don't understand why it's on the left, now it's correct. Okay, so that's it for the consolidated net income. We can also calculate the group share over the consolidated net income or the minority interests over the consolidated net income. I'm going to do it with minority interests because it's just about. So minority interests over group share. So of course, it's not very useful for the first year because it will be a negative. Okay, so well, so you can see what I've done. Minority interests, line 22, over group share, line 21. And I'm not going to keep the zero. I'm going to say that it is a percentage, which is 12.4%. And I have no idea of what it would be should be in the future, but normally there is no reason why it would be meaningfully different. So I'm going to keep the 12.4% from 2021 onwards. So I'm always going to have 12.4%. So I let you have a look at that. before going on, of course. So, having said that, if we know that the minority interests represent 12.4% of the group share, of course, we can calculate the minority interests from 2022 onwards. I simply have to apply 12.4% to the group share. And of course, we can do that at this stage, only till 2024. Of course, you can see that the sum of the group share, 4,833, and the minority interest, 598, is equal to 5,435, which corresponds to the consolidated net income. Save. And we are going to go on. I mean that based on that, we can calculate the corporate tax rate. I mean that the corporate tax rate for the two first years is the income tax divided by the earnings before tax. And I've put a minus sign in front of it just in order to have a positive percentage. So that's it for the first years. Then I'm not going to say that it is 21.1% systematically. I mean that, first of all, for French people, I should say for most European people, 21.1% is a very, very low corporate tax rate. It is a very, very low corporate tax rate because in France, a generation ago, about 30 years ago, the corporate tax rate was 50%. From this year onwards, from 2022 onwards in France, it will be 25%, which means that 21% does not exist. So why do we have that? Société Générale is a French bank, and the lowest corporate tax rate we've never had in France is 25%. But there are two explanations. The first one is that Société Générale has some subsidiaries outside France, whereas the corporate tax rate can be lower. And of course, when we base the calculation on consolidated accounts or on forecasted consolidated accounts, we get, when we divide income tax by earnings before tax, we get a weighted average corporate tax rate, which means that if inside the consolidated group you have subsidiaries in countries with a lower corporate tax rate, you have a lower consolidated corporate tax rate. But that's not the point. The point is that there have been some losses in 2020, generating tax losses which have been used in 2021. So what I want to say at the end of the day is that we can't assume that 21.1% is a recurring corporate tax rate. We can't assume that, and we are equipped to calculate the forecasted corporate tax rate till 2024. I mean that for all these years, from 2022 till 2024, we know the earnings before tax, and we've known for about 5 or 10 minutes the consolidated net income. So by difference, you have the corporate tax, you have the income tax. which should be the difference between 6,191 and 3,912. But as I want the income tax to be signed negatively, this is why I have put some brackets for the name of the aggregate. And as I'm a bit lazy and I do not want to have to open and close brackets, I'm going to calculate the income tax as the difference between the consolidated net income on the one hand and the earnings before tax on the other. So you can see the great advantage of what I've done is that you have immediately a negative amount. Please keep in mind that the amounts which are there are completely wrong, but the formulas are correct. Once we will have filled in these cells, everything will be adjusted in less than 5 minutes, properly and accordingly. So again, the income tax is the difference between consolidated net income and earnings before tax, just in order to have directly the amount signed negatively. So if we know the income tax, which has just been calculated here for 2022, here for 2023, here for 2024, we know the corporate tax rate, which is the income tax over the earnings before tax. Again, I'm putting the minus sign in front of the ratio because I do want a positive corporate tax rate. You've never heard the corporate tax rate is minus 25% in France. It would mean, if we say minus 25%, it would mean that people, no, not people, I should say, corporate entities will receive cash from the state, which is not the case. So let's copy and paste the formatting. And if I extend the formula, you can see a more customary corporate tax rate for 2024, which is 33.2%. Again, which calculation has been done, minus to have a positive corporate tax rate, F17, which is the income tax, over F16, which is the earnings before tax. So we get here 33.2%, which is a recurring corporate tax. And we are going to keep it onwards, from 2025 onwards. So we say it will always be 33.2%. And as we know now, as we know now the corporate tax rate, as we know the earnings before tax, which have to be taxed, we can apply the 33.2% to the earnings before tax. And we can say minus 33.2% times the earnings before tax. And I can extend the formula till the end. I'm showing the formula. I have just applied the corporate tax rate, which has just been calculated for 2024, namely 33.2%. And I've decided to sign negatively the income tax, so I type minus 33.2% times the earnings before tax. And to terminate, because we've almost finished the income statement, and calculate the consolidated net income because it's the earnings before tax minus income tax. So earnings before tax minus, I'm saying minus, I'm typing plus because I have signed negatively the income tax. So plus the negative amount which has been calculated here for the income tax. And of course, what I've done for the year 2025 can be extended or copied and pasted after that. So we have the consolidated net income, and we are going to have the breakdown between group share and minority interests. For that, for the sake of clarity, we could prevent from adding the line as I've just done, but it will be more comfortable for everybody if I calculate the group share over consolidated. So let's do it here. Group share 5,641 over consolidated 6,338 for 2021. You can see that if we recalculate, it's always the same. And we are going to say that this 89% will be kept beyond 2024. So we can say that from 2024 onwards, it will always be 89%. And you would probably agree with me if I tell you now that we've almost finished. We know the group share over consolidated. So if I apply this 89%, if I apply this 89% to the consolidated, I have the group share. I'm going to show the formula again. 89% times the consolidated net income, which is above in the cell in red G20. That's it. And if we know the total, the consolidated net income and the group share, just for information, just for the sake of clarity of the table, we have the minority interest, which is the difference between the consolidated net income on the one hand and the group share on the other hand. And of course, nothing prevents me from extending the formula till the end. And at the end of the day, we have the consolidated net income till the year 2027. So we do not perform the valuation, as you can see, but we've prepared what's necessary to do it. So I'm just coming back for a couple of seconds here, just to be sure that you do not have questions. If you have some on what we've just done, please tell me. No question? So if there is no question, I have the feeling that we can go on. So we have the income statement. All right. Once we have the income statement, we're very happy to have it. We want to practice the DDM valuation. I would like to come back to what I said last time. I don't find the file because it's a bit special when you use OneNote. So I'm going to open a new one. It's absolutely possible. Maybe I will have it here. Although I got to find it. I don't know where it was, but this is what I was looking for. So what I said last time, and this is what we are going to apply, is that if we want to calculate the equity value of Société Générale, we need to sum to perpetuity, to plus infinity if you prefer, some present values of future dividends. So the problem we have now, before dealing with the cost of equity, the discount rate, before dealing with the principle to sum 2 plus infinity. First thing we need to do is to calculate the yearly dividends to be taken into account. And I said, and I've not changed my mind so far, that it's not exactly the dividend which will be paid out to the shareholders. It is the dividend which could be paid out to the shareholders, which could, not which will be, which could be paid out to the shareholders, keeping in mind that after this dividend payment, the common equity tier 1 ratio will be equal to a target common equity tier 1 ratio. I will come back in a few minutes on the use of the terminal value. But the most important point is to understand what the dividend will be. I remind you the calculation I've done on the 100% basis with you last time. And in the coming seconds, we'll do it with the figures of Société Générale. So the idea is the following one. We assume that we are dealing with a bank which has a common equity tier 1 on the 1st of January of 100. The net income of the year is 10, which means without using Excel or a calculator that the common equity tier 1 on the 31st of December is 110, 100 amount at the beginning of the year plus net income of the year. Of course, 100 plus 10 is 110. And we assume that the risk-weighted assets of this bank are worth 1,000, which means that there is a comfortable common equity tier 1 ratio. I mean that if I divide, and I know that it's not what I've done, but if I wanted to divide the common equity tier 1, 110 by 1,000, I do not need Excel or my calculator to tell you that the common equity tier 1 ratio is 11%. But we assume here that the target, or the required, we could say, common equity tier 1 ratio of this bank is 9%, which means that with 1,000 risk-weighted assets, only 90 is required for the common equity tier 1. I mean that the bank would be just content with 90. Because if it was 99% of 1,000, if the common equity tier 1 was equal to 90, the common equity tier 1 ratio would be 90 over 1,000, or 9 over 100, which is 9%. So the idea is that we would like, I shouldn't say would like, we would be just content with 90, and we have 110. So we have too much compared to what is required. We have some excess common equity tier 1, which is the difference between 110 and 90, which means 20, which could be paid out to the shareholders. This is the dividend. And we are going to calculate the excess equity for every year. And this will correspond to the dividends to be discounted in order to have their present values, which will have to be added in order to have the equity value. So please keep in mind that we start from a common equity tier 1 at the beginning of the year, 1st of January or 2nd, or to tell me nobody's working on the 1st of January, plus the net income of the year. It gives you the common equity tier 1, and you compare that with the target common equity tier 1 ratio applied to the risk-weighted assets. So this is what I explained last time, and normally I have sent to you this sheet also. So now let's do it with the real figures of Société Générale. So let's keep in mind what I said. We are going to start with the common equity tier 1 ratio. The common equity tier 1, sorry. As at the 1st of January, or at the beginning of the year, as you want. Then you have the net income of the year. And then you have the common equity tier 1 at the 31st of December. I could have put that below just in order, for the sake of clarity, to say this will be equal to very strong added value for my side. Okay? So, in terms of calculation, everybody will recognize that I've done absolutely nothing. I have only presented the page. And we're going to fill in these 3 or 4 lines before having a break, you see? So, common equity tier 1. And of course, after that, you have the risk-weighted assets. And I have to tell you that I am more familiar with having risk-weighted assets below. So I'm going to put them here, which doesn't change anything. Please do not copy and paste. You cut and paste. Otherwise, there are problems with formula. So I have only reorganized the bottom of the screen, but no calculation, honestly, has been done so far. So now, 2021. We are not going to prepare the breakdown because we have the final information. Look, we have this table on the right, and at the end of 2021, 31st of December 2021, so this is the column, I don't know if it's in pink or in red, seems to be in pink for me. Okay, the common equity tier 1, CET1, is 49.8 billion, 49.8. So 49.8. And I would like to remind you that we are dealing here with billion. We are dealing with billion euros. So, and we know here the risk-weighted assets, which have also been taken from the same table. We've seen that at the beginning of the course. I'm going to show it again. 363 for risk-weighted assets in 2021. Look, sorry, it goes a bit too fast. Okay, so risk-weighted assets, 363, as you can see. So if we know common equity tier 1 and the risk-weighted assets, we can calculate the common equity tier 1 ratio, which is CET1 over RWAs. So let's say common equity tier 1 over risk-weighted assets. And you have, as you can see, 13.7%. If you do not trust me, it's possible not to trust me, you can also go on the left and see what's been calculated by Société Générale itself. And you can see that indeed, common equity tier 1 ratio, 13.7%, which does mean that everything seems to be consistent, 13.7%. So What will the ratio be in the future? Of course, we know that it will probably be improved. This is the goal of every bank, to increase or to improve its net income on the one hand and its common equity tier one ratio on the other hand. Do I know what it will be? No. Does any financial analyst know? The answer is no. So we're going to say, let's keep it beyond 2021. Let's imagine that what's been achieved in 2021 will have to be done in the future. It needs a second figure after the point. I can extend, and of course, I'm going to reduce slightly the scale so that we can see every year. So, as you can see, we have now the common equity tier one ratio, and we are going to say that we want to have always the same common equity tier one ratio. I mean that what we've seen in 2021, 13.7%, would be the target common equity tier one ratio. Okay? So, having said that, if we take the year 2021 into account, in fact, you can see that you have 363, which represents, sorry, you have as a common equity tier one 49.8, which represents 13.7%. And if we want it to be the target common equity tier one ratio, I'm going to write down target common equity tier one ratio. There you can say what the required equity is for every year. Is that it is equal to the ratio applied to the risk-weighted assets. And we are not surprised for the first year that it is exactly what you have here. And of course, you can extend. This formula is 13.7% times the risk-weighted assets. As we know for every year, the risk-weighted assets, because we knew the risk-weighted assets at the beginning, and we align the growth rate of risk-weighted assets on the growth rate of the net banking income. So once we have that, we can say that the required equity is a formula which can be taken into account until the end. Let's take this year, for example, 13.7% times the risk-weighted assets. So I'm going to save. I'm going to ask if you have questions, and if not, we will immediately do the break. Are there questions at this stage? And can we have the break now? No question? Absolutely no question? So I suggest we have a 10 minutes break till about 3:15 for my time. But let's say 10 minutes, whatever time you have. Okay? So normally I have switched on the sound again. So normally it should work. Can we go on? I'm asking just to be sure that there is no issue, that you can listen to me, you can... Yes, you are ready. That's absolutely perfect. So, I will come back in the chat, but I need to share my full screen, otherwise it's too small, as Lynn explained the last time. So, in fact, what did we do just before starting the break? We took into account the common equity tier 1 at the end of December 2021, 49.8 billion. We took the risk-weighted assets, 363 billion, and we calculated the common equity tier 1 ratio, which will be looked upon as the target common equity tier 1 ratio beyond 2021, and we obtained 13.7%, which is consistent with what you have on the table, which is on the top right of this sheet. So if we know the risk-weighted assets between 363 in 2021 and 429 in 2027, if we know that we want a 13.7% common equity tier 1 ratio, we can calculate the required equity, the equity we should find in the accounts in order to have a 13.7 common equity tier 1 ratio, which is calculated applying the target common equity tier 1 ratio, namely 13.7%, to the risk-weighted assets, which for 2022 happens to be 349. So this is the required equity for every year. I don't know if it's a question from the chat. I know it's an email I have received. So it's not, I thought it was a question, but it's not the good noise. So in fact, no issue. So having said that, for the year 2021, we do not account any dividend distribution because anyway, it's been done. I mean that we know that the 49.8 billion is calculated after taking into account the dividends payment. Why do I know that? It's because I have looked at the table from which we've taken the common equity tier 1 capital and the risk-weighted assets. And you can see that to get the common equity tier 1 capital from the shareholders' equity group share, the dividend for the previous year, based on the net income of the previous year, have been deducted. So it's a very good point to say that we want to stick to this 13.7% common equity tier 1 ratio, which enables not to include any additional dividend beyond the one which has already been paid out to the shareholders. For the future, it will be completely different. So if there has been no additional dividend to be paid out, it means that the common equity tier 1 at the beginning of the year 2022, on the 1st of January 2022, will be equal to the one at the end of the year 2021. At this stage, it's very basic, but it will not be as basic as it's here for all the years. I'm going to explain why. Okay, so of course it's the same. It's only a matter of formatting. Okay, I'm a bit fed up with this formatting, but normally now we do not have any problem anymore. So this is the common equity tier 1 at the 1st of January. I could have put that way. The net income of the year The consolidated net income of the year is here, as you can see. But we need to keep in mind that this table is supposed to be in billion euros, whereas the income statement, which is just about, is in million euros. So, of course, we need to turn these million euros into billion euros divided amazingly by 1,000. And of course, this can be extended till the end. I'm going to reduce very slightly the size of the cells. Okay, so you can see where this 3.9 is coming from is 3,912 over 1,000. 3,912 million means 3.9 billion. And at the end, 6,009 million is 6.0 billion. And of course, I can calculate the sum, which is the amount at the beginning of the year plus the net income. And if I can always extend the formula because we can guess that we will have the right amount for the common equity tier 1 at the beginning of the year for every year from 2023 onwards. So we can anticipate that the missing data will arrive honestly in less than 2 minutes. So the amount at the beginning of the year plus net income is equal to the amount at the end of the year. So what can we see? We're going to focus for a few seconds on the year 2022. We can see that the common equity tier 1 will be 53.7, whereas the required equity is only 47.9. I mean that the common equity in the accounts will be more than the required equity. Saying things differently, in a more simple way, there is too much equity. I mean that we will be happy with just 47.9 and we have 53.7. So we have an excess equity, which will be the theoretical dividend, which could be paid out. This is the dividend, which is useful for the dividend discount model. So we can say, just for the sake of clarity, that here we have an aggregate, which is a number 1, and here you have an aggregate, which is a number 2. It happened that the dividend will be the difference between what we have in the accounts, number 1, and what we need, what we require, which is the number 2. Based on that, it's very easy to perform the calculation. What we have in the account, what we will have in the accounts minus what we want to find in the accounts, namely only 47.9 billion. And the difference is, going to format properly, is 5.8. 53.7 minus 47.9 is 5.8. We can guess that we will eventually have the amounts here. So we can extend the formula, not as far as I did, but I feel like saying till the year 2027. Don't worry, once we filled in these cells, this will be positive. So now, what will be the amount we are looking for from now on? At the beginning of 2023 for the common equity tier 1. In fact, there are 2 ways to proceed to get the same output. There is one which is a bit heavy, which is not far from being ridiculous, and there is a better way. I'm going to start with the heaviest presentation, which consists in saying, well, we have at the end of December 2022 a common equity tier 1 which is 53.7. Right. Given the required equity, we have an excess equity which is 5.8. So we can pay out 5.8 as dividends. And if we pay out 5.8, if we say 53.7 minus 5.8, we will have necessarily 47.9 because 5.8 is the difference between 53.7 and 47.9. So if we do the calculation in another way, necessarily 53.7 minus 5.8 is necessarily 47.9. But do we need to put it? The answer is no. We are simply going to say that at the end of December, we do have 53.7. We pay out 5.8, which means that we start the year 2023 with what the equity will be after dividend payment. After dividend payment, it is a required equity, which means that if we pay out dividends every year for a consideration corresponding to the excess equity, we necessarily start the next year with the required equity of the previous year, which means that again, if we terminate the year 2022 with 53.7 common equity tier 1, and if we pay out 5.8 as dividend, we have a common equity tier 1 for consideration of 47.9, which is the required equity. So we do not need to calculate anything more. We can necessarily say that every year, and I'm copying and pasting the formula, every year, we can do it for 2025, for example, the beginning of the year for the common equity tier 1 is equal to the required equity of the previous year. If you want to be convinced, I'm going to tell you, at the end of 2024, we have a common equity which is worth 55.8. We pay out 3, so we have 52.9 or 52.8, it depends, 52.9, okay? Because it's not exactly 55.8, there are figures after the point, and it's the same for that. And then we have the dividend to be paid out and to be taken into account if we want to have the equity value. I mean that we are going to calculate now the present values of the dividends. Okay. So before all, I'm going to check in the chat if you have questions. No question on that? No question? If there is no question, I'm going on. So, maybe before calculating the next line, I would just like you to see again the formula I've written down last time. I said, and I do not change my mind today, that again, the equity value, as you can see in the middle of my screen, is the sum of the present values of dividends to perpetuity, to plus infinity, as you can see. Personally, I'm completely unable to prepare forecasts so far. But we also know that this formula can be broken down into two ones. As you can see, if you look at the number 2, which is written down here, and I'm going to highlight that, for example, in green. Okay, to highlight in green, as you can see. And we are going to focus on that. I mean that we are going to start with this sum on the n first years of the business plan. I mean, for the years for which we have the information. So let's do it. But before doing it, last point to be reminded to you is that we need a discount rate. We need a discount rate. You can see there is a discount rate here, as there is a discount rate here. And we know that the discount rate is the cost of equity. And the cost of equity, as written down here, is the risk-free rate, or RF on the line above, plus the beta times the market risk premium. So first thing to do, in order to calculate this first sum, is to have the cost of equity. Luckily, everything has been prepared. I have inserted too many lines, but that's not a major issue. You are said, I'm going to cut and paste here. We have the risk-free rate, we have the market risk premium, and I should put here the beta of Société Générale. Okay, and the beta has changed over time, and it was at that time about 1.7. I'm going to check while speaking to you, but if I remember correctly, it will take a few seconds, of course. I think it was 1.7. Anyway, we can, of course, change if necessary the level of the beta. I'm going to tell you in the coming seconds. It will arrive in less than a minute. Okay, and to tell you which beta has to be taken into account. Just for the sake of consistency, I should have put it, but well. Anyway, we're going to put 1.7, and when I have the information from my iPhone, I will change it, but I think it is 1.7. 1.7, which means that it is an aggressive stock, as you can guess. 1.7. So normally, I think that you will agree that the cost of equity based on the CAPM, capital assets pricing model. So now I have access to the information for the beta. I was not very far when saying 1.7 because it is 1.64. So I was not very far. So having said that, the cost of equity, as I said, as I wrote down, is a risk-free rate plus the beta times market risk premium. And you have then the cost of equity, 13.4%. So I think that we can now calculate the present values of the future theoretical dividends. So, but I have to tell you that there is a slight issue to be dealt with. I mean that I'm not going to say that 2022, which is the first forecasted year, is in a year, and that 2023 is in 2 years. I mean that when you perform basic calculations, from an academic point of view, it's probably what you're used to doing. But in real life, you do not do that. You do not do that because if you say that 2022 is in a year, it means that you are performing the calculation on the 31st of December 2021. But in many countries, in Europe in particular, on the 31st of December 2021, nobody is performing any valuation. People are preparing the end of the year. Nobody is working. You could say, but it's the same on the 1st of January 2022. Yes, but it's a banking holiday. Nobody is working on the 1st of December, on the 1st of January. So it means that when you practice valuation, for example, in investment banking, but also as analysts, you perform valuation at any time in the year. And for example, as I said, we are doing a valuation here based on figures just before the war in Ukraine. I mean that the date I should have written down for the sake of clarity, valuation date. Okay, and here I should have said, I should have written down closing date. Valuation date is the 21st of February. And when you are on the 21st of February, the 31st of January 2022 is not in a year. It's not very far from a year. But, well, it's a bit less. So we need to calculate separately the difference between the closing date and the valuation date. We are going to say that in days, can calculate the difference between the 31st of December and the 21st of February. And you can trust Excel, which can easily add and subtract some dates. There is no mistake, otherwise Bill Gates wouldn't be one of the richest men in the world. So you have 313 days, which means in year, if you divide by 365 days in a year, you can say that when you prepare the valuation on the 21st of February, the end of the year is in 0.86 year. And this is why I will account for. So I'm going to write down discount period, which is necessarily in years. I'm going to get rid of some lines so that we can see an additional one, even if we need maybe to add one. So now we're going to say that 2000, we can see it, okay, 2022 is in 0.86 year. Okay, I could hide that, okay, so that it will probably be more self-explanatory for everybody. You see? So I think it's better that way. So discount period in 2022, we can say that we have 0.86 year till the end of the year. So 0.86 year. And for the next year, you add 1 plus 1. And you can extend till the end. So this is for the discount period. Then I will need a line for the discount factor. Sorry, for the discount get to do it, factor. I mean that I would like to put a number, a simple number, which will have to be multiplied by the dividend to read its present value, which means that the discount factor, keeping in mind that the discount rate is 13.4%. 13.4%. So what is the discount factor for the year 2022? It is 1 over 1 plus the discount rate in the power 0.86. This is the discount factor. Of course, I am about to type enter and to copy and paste this formula on the right, or to extend this formula on the right, as you prefer. And I want the 13.4% to be always taken into account. I want it to be a fixed reference, hence the dollars for BN41. If you want to put some dollars, I would like to remind you that if you're on a PC as I am, you type on F4, and if you are on a MacBook Air, you type on Command T, which prevents you from typing $B$41. Of course, it's going to be formatted. Okay, and I can easily extend till the end. This is the discount factor. And once you've entered this basic formula, if I may say, and extend till the end. Why am I doing that? I'm doing that because when you present a DDM, or it's the same principle, a DCF, as an investment banker to a client or to a prospect, namely to a CEO or a CFO, everybody knows how to calculate a present value. You are a CFO, you are the CEO of a big enterprise, you know the formulas, of course. If you can see, for example, for the last year, that you are 4.3, and you have a discount rate which is 13.4%, you know that the present value will be 4.3 divided by 1 plus 13.4% in the power 5.86. But without a calculator, even if you are personally a great calculator, a very performing, you can do it. If you have this discount factor, what does it mean? It means that if you have the dividend, and if you want its present value, you only have to multiply by 0.48. Rounding figures, you divide by 2, and you have the present value. So it's far more explicit, far more self-explanatory. Okay? So having said that, I need to add a very last line, which will be the present value. Sorry. So that way, present value of dividend. So based on all what's been done, as I've said, I only have to take the dividend and to multiply by the discount factor. Only one figure after the point will be enough for me, and I can extend till the end. And as I said, you divide more or less 4.3 by 2, multiplying by 0.48 is more or less dividing by 2, and of course you get 2.1. So this is here the present value of dividend, which is the most important line after the excess equity. So we've almost finished. We will finish before the break, because we know the present values of dividends for every year. We need to calculate the sum and to add the terminal value. And we have the equity value. It's not a corporate entity. The discount rate is not the WACC. So we do not need to deduct the net financial debt. I wouldn't be able to calculate for a bank. We don't know what a net debt is for the bank. So it's a good thing that we base our calculation on dividends. So we're going to calculate here the sum of present values of, let's be explicit, 2022, 2027 dividends. Okay? So for the sake of clarity of the presentation, I'm going to put that here. So sum of these values, present values of dividends. And you have 15. Okay, you have 15 billion. I'm going to show again what I've done. Of course, it can't be the equity value of Société Générale, because something is missing here. We've only done part of the job. I mean that we've taken into account the forecasts till the end of our business plan, namely 2027. But if we look at what I've said, well, we've calculated that. Now we need that. We need the second sum. We need what we are used to naming, as you can see, the terminal value. That's it. The terminal value has not been evidenced during our previous course because it's exactly the same idea as the one for the DCF. I mean that we simply replace the last free cash flow by the last dividend. First point. Second point, we replace the big K WACC, weighted average cost of capital, by the cost of equity. But we only change notations, which enable me not to waste time providing the proof of the formula. So we are going to apply the formula. But before applying the formula, I would like to show you something which will simplify our calculations. I would like you to be focused on that. Of course, the formula is what's written down, dn times 1 plus g over 1 plus k in the power n, and over also k less g. But what I want to say is that what I have in blue is the present value of the last dividend. dn is the last dividend, and if I divide by 1 plus the discount rate in the power n, I have for sure the present value of the last dividend. Why am I saying that? I am saying that because the present value of the last dividend is known. I do not have to take 4.3 and to divide by 1 plus k in the power n. Because if I do that, I'm 100% sure that I will get 2.1. So this is the present value of the last dividend, which means again that I'm going to base the calculation on that. I mean that instead of highlighting it in black, I could have highlighted it in blue for the sake of consistency. It's not the right blue, but we are not going to waste 2 hours on the choice of the color, but I can see it here. Okay, so to do it better. Well, 2.1, it's here. So I mean that if I come back to that, here we have 2.1. So we simply have to multiply 2.1 by 1 plus g and to divide by k less g. And that's it. So the formula, which looks a bit heavy, at the end of the day is not that heavy because dn over 1 plus k in the power n is already calculated. So let's do it. We are going to say that we have the terminal value, which is at the end of the day present value, I'm going to write down PV of last dividend times 1 plus G over K less G. If you were to pitch a client, or if you are the CFO preparing your report on that for the CEO, you do not write the formula. It's just for the clarity of the presentation. I'm writing it down. And I'm going to write down nota. PV means present value. So once we have this number, we have to add, and we will have the equity value. So as I've said, we are not very far from the equity value, which will be there. So the great issue, which is not a real issue, honestly, is to calculate the terminal value. The terminal value, which is the present value of the last dividend, namely 2.1 times 1 plus G over K less G. What is K? The cost of equity is K. Again, you shouldn't present that to a CEO, but it's to simplify the reading of what we've done in the future. Okay? What is G? So G is the perpetuity growth rate. And I would like to remind you, because it's been done a while away, that we've had a soft landing of the business plan so that the growth rate of the last year is consistent with the perpetuity growth rate. We needed to have a real long-term growth rate, which is, as you can see, 3%. This is our perpetuity growth rate. Okay, so we are going to say that it would probably be better to have here the perpetuity growth rate, okay, which is 3%. I prefer, and I'm going to adapt the model, of course, accordingly, I prefer to enter everything here. So please look at what I'm going to do. I have indeed entered 3% here. And on the very top of the model, I'm going to say, well, we take this 3% perpetuity growth rate, which means that here the 3% will now come from this cell, 3%. Of course, it doesn't change anything. And now, of course, it's no more entered, it's calculated because it's a very complex formula. It's equal to what we have on the bottom, 3%. Okay, you recognize the 3% here, the 3% which is there. So if we know the perpetuity growth rate, just for the sake of clarity, I'm writing down G. Okay. We know the present value of the last dividend, which is indeed 2.1 times 1 plus G, 3% over K less G, K being 13.4% minus 3%. And of course, I do not need so many figures after the point. You can see that the terminal value is 20.3. I'm going to show again the formula. I'm taking the present value of the last dividend, namely 2.1, times 1 plus G, 1.3% over K less G, K being the discount rate, 13.4%, minus perpetuity growth rate, 3%. So we have a terminal value, which is about 20.3. I can add these two amounts just to say that at the end of the day, the equity value I was looking for, okay, the equity value I was looking for is 13.3%, 13.3 billion euros. This is what we could assume just before war, just before the war in Ukraine. Before moving on, are there, or having a break, are there some questions? Of course, as you can imagine, at the end, everything is put on the system, on Canva, so you have it anyway at the end. But before having the break, do you have question on that? I had said we would finish the valuation before the break. It is finished. No, not the course for today, but the DDM valuation of Société Générale. No question? No? So if there is no question, let's have a 10-minute break again. Okay? I can see that somebody is writing something. Maybe it's a question. So no, it's okay. It's clear. Thank you. So let's have a 10-minute break as we had previously. it's better if I plug the sound. So, we've done what I wanted to show you regarding the DDM valuation approach, as you can see here. And now we are going to speak about M&A regarding banks, and then I will spend a bit of time, not much, on insurance companies. So, of course, as I said, this will be put in the Canvas system at the end. So I have said, and I think that you have a real illustration on that for the valuation purpose, we need to include the solvency constraint. I mean that the free cash flow is replaced by the dividends, which correspond to excess equity from a solvency point of view. I have to say that if you want to imagine, to contemplate an acquisition of a bank by another one, you also need to see the impacts of the contemplated deal on the solvency situation. Well, I do not need to write down many things around that, because I have to say that if you contemplate M&A transactions, there is a common point, because what you've done in other courses, probably with the Professor Alain Chevalier, for corporate entities, and what we will do together for financial institutions. I have a question to ask you, and either you answer directly or you answer in the chat as you want. Okay? If you want to study the acquisition of the company A by the company B, what do you calculate? What will enable you to say, well, it's okay. It's possible to launch a tender offer. It's possible to buy. It's possible to contemplate the M&A deal. Do you have an idea or not? No idea? No idea? Why would we have an M&A deal? I mean, well, you have, for example, let's take a cross-border contemplated deal which has been abandoned because of the French Minister of Economy, Bruno Le Maire. I mean that the food retailer Carrefour, which is the challenger of Walmart from the global point of view, was about to merge with Couche-Tard, which is a retailer, a food retailer in Canada, mainly in Canada. Of course, it's also a global firm. So what do you need to calculate in order to check that it's possible from a financial point of view to have an M&A deal? No idea regarding what can be done? No? Even if it's a mistake, it's not an issue. You can say what you want. No idea? I'm going to tell you, it's not what I'm going to do, because I'm not going to deal with a corporate entity. I'm going to deal with a financial institution. But I would like to remind you what you've heard. You've heard that if you want to have an M&A deal between two corporate entities, you need to check that the deal is acceptable for two categories of stakeholders. First of all, it has to be acceptable for the banks which will finance the deal. And there are some ratios you've probably heard about, such as the gearing ratio, debt to equity, the repayment capacity, debt to EBITDA, the interest coverage, EBIT over net interest. But these constraints do not exist for banks when they are buyers. These are constraints for their clients when they want to finance a M&A deal. But for the banks themselves, this does not exist. This is why I'm not writing it down, keeping in mind that it's probably been written down by the professor who studied with you M&A. So first of all, you need to get the cash to do the deal. You need the cash. So you need to satisfy the banks. But you also need, and I should have started with that, your shareholders. And the shareholders are not necessarily, for most of them, they are not necessarily finance specialists. They are not asked to be finance specialists. They're already very kind to be shareholders. And in fact, they have mandated a CEO in order to manage a firm on a day-to-day basis. So the only thing which is important for a shareholder, and it's not a criticism, it is a reality. I am a shareholder of a firm, of a listed firm, and I am as the shareholders I am mentioning. When you are a shareholder of a firm, you are only looking at the evolution of the stock price. And if you're looking at the evolution of the stock price, you need to be sure that any decision, operating or strategic decision, has to enable an improvement of the share price. And what I'm saying is valid if you are the shareholder of a bank, if you are a shareholder of a firm in the metal and mining industry, in the technology, media, telecom industry, in the automotive industry, in the aerospace, in whatever industry you want. I mean that the shareholders are necessarily waiting for an improvement of the stock price, of the shares, of the stocks they have in their portfolios. And this is what we will take into account for banks, but it's not a specificity of banks. Of course, we will do it. It will be a kind of refresher of what we've seen in another course. For banks, we also need to check what the common equity tier 1 ratio will become after the deal. And for that reason, we are going to take a numerical example. You can see in the document I have sent to you, not to you directly, but I've uploaded on the Canva, that there is another sheet, you see, which is mentioning, as you can see, BNP Paribas, BNP, and Société Générale. Okay, so as you can see, you have here some data at the end of market data. It's not on the 3rd of, it's on the 9th of March. So it's consistent with the beginning of the war in Ukraine. So you have for BNP Paribas, for General, the share price in dollars. I've put in dollars, so it's a mistake. It is in euros. Okay, you have the number of shares and you have the market cap in billion euros. Of course, I multiply these two numbers and I multiply the amount in euros by a number of shares in million. So normally I have an amount in million euros, but as you can see, I divide it by 1,000 to have billion. So BNP Paribas has a market cap which is about 59 billion. Société Générale had at that time, and it's more or less the same today, a market cap which is 90 billion. You have for these two famous banks the common equity tier 1 and the risk-weighted assets. You probably remember that the risk-weighted assets were there, has already been taken into account. Well, 363, okay, 363, you have to show the line 363 there. So I mean that instead of entering it here, I could have picked it from here. It's the same, of course. It's the same, and I can, it's the same. It doesn't want me to put it in green, which is not a major issue. Well, yes, I know why. Because it's not, sorry, I have to change the font very simply. So, just a second, rid of that. I'm going to come back here and to say it is here in green. So, you recognize 363 and 49.9 for the common equity tier 1. Well, it depends on the source you take into account. It depends on the way you calculate. It's 49.8 or 49.9. I mean that in this table you have here the detailed calculation. I mean that we start from the consolidated equity, which is in the balance sheet of the company. You deduct some subordinated notes, which are accounted for in the consolidated equity calculation, but which are not looked upon as common equity tier 1. So we neutralize them. You have the same point for BNP Paribas, for Société Générale, and you can imagine that you have that for many banks. Then the dividends distribution is deducted, goodwill and intangible assets are deducted, and other regulatory adjustments are deducted. What I want to say is that the calculation which is done here, starting from the consolidated equity, including group share and minority interest, is exactly what you have in the table of this other sheet. You can see here that you have exactly the same calculation. I can try to show simultaneously just for a few seconds the two tables. It's not very easy, but just for the sake of clarity. I know because it's in another sheet, it's the same file, so I can't. So we start from 65.1 and we get 49.8. This is exactly the same. In fact, there is a problem of rounding in between, but it's not an issue. So we have the same kind of calculation for, on the one hand, Société Générale, as we could see in the table which is there. And you have the same kind of table for BNP Paribas, which enable me to have the same kind of calculation in the column B. And where are the figures coming from? They are necessarily coming from an official source, which is in the annual report. Here it's a presentation to the market, but of course it is also in the annual report. And you can see that the common equity tier 1, deducting subordinated notes, deducting dividend distribution, deducting regulatory adjustments, goodwill and intangibles is 92. We start from 122.5 and we get 92. 122.5 and we get 92. We have the risk-weighted assets, which can easily be found in the presentation. And if we calculate the ratio, common equity tier 1 over risk-weighted assets, again, you get the common equity tier 1 ratio, which is 12.9%. Okay, you can see you add here the risk-weighted assets, 714, and the common equity tier 1, 12.9%. So everything is perfectly consistent. So we have the calculation in the first column for BNP Paribas. I'm going to reduce the size of these cells so that we can see everything. Okay, and what I would like to do first of all is whether to calculate the ratio, the common equity Tier 1 ratio of BNP Paribas after a contemplated transaction, a contemplated M&A transaction on Société Générale. I would like to say, because I'm not sure that you're aware of that, only French people are aware of that, in the past, in 1999, so it means 23 years ago, BNP decided to launch a tender offer on Société Générale. In fact, to tell you what the situation was at that time, Société Générale on the one hand and Paribas on the other end had discussed a direct merger, and everything was ready. Everything has been studied. Everything was forecasted, including who would be the CEO and who would be the chairman. And when the deal, I mean the merger between Paribas and Société Générale was announced, BNP realized that it would be a great issue for BNP Paribas because the new group made of Société Générale and Paribas would be a very, very strong group. So in that context, BNP decided to launch a double tender offer, one on Paribas, which was at the end of the day a success. And this is why we are now speaking about the BNP Paribas group. And BNP didn't get to obtain the control of Société Générale's capital. And the CEO, which was also the chairman of the board of Société Générale, who is a current, no, it's not the current, it is a former president and CEO, Daniel Bouton, obtained from the government to ask BNP to get rid of its Société Générale stake. So it means that nowadays you have BNP Paribas on the one hand, and you have Société Générale on a standalone basis. Personally, but it's only a personal view, I do not think that there will be in the near future tender offer of BNP on Société Générale. Why? I'm going to tell you why. It's simply because 20 or 25 years ago, a bank was really strong if it had many branches. Nowadays, people do not go to their branch to discuss with the bank. People prefer to do that on a smartphone or on a laptop. So I mean that the value of a bank is more important as it has a limited number of branches. And of course, I am not sure that BNP Paribas would be very happy to get all the branches of Société Générale. But even if it's not necessarily a good deal for BNP Paribas, it can be completely excluded. And I only want to illustrate the financial principles based on this potential deal, keeping in mind that as BNP Paribas on the one hand and Société Générale on the other hand as they are listed, it's very easy to have the financial information if the firm is not listed, except if you are the advisor of one of the firms, you do not have the financial information. So I would like to reconcile the common equity Tier 1 ratio of BNP Paribas after a contemplated purchase of Société Générale. So it's an opportunity to see how to consolidate equity, to consolidate common equity Tier 1, and to consolidate risk-weighted assets. So let's start with the consolidated equity. So, of course, we are necessarily inclined to add the aggregates of BNP Paribas with the aggregate of Société Générale when we consolidate. So we feel like, and I feel like so much doing it, that I'm going to do it to calculate the sum of all what we have on the same line. From the column B to the column E, I do feel like doing that. I do feel like doing it here. I do feel like doing it here. Well, I do feel like doing it on each cell. And I have to say that without Excel, it would have been a bit more painful. But luckily, we have Excel, which calculates everything. So you can see what I've done. I calculate the sum of all the amounts we have on the same line. So I have to tell you that it's not the definitive output. We are far from the definitive output. We are far from having the definitive output for 3 reasons. Or 4. The first one is that, amazingly, when you buy a firm, you buy its shares, the value of all the shares being the equity value, but you do not get the shareholders' equity group share of your target. I mean that you get its minority interests if there are some, and there are minority interests in the balance sheet of Société Générale. It's funny to see that it's the same amount in the BNP Paribas and Société Générale's balance sheet. Well, but you do not get the shareholders' equity group share of your target. Why? It's because you have to pay. You have to pay for that. So if you have to pay, let's imagine that you pay the amount of the shareholders' equity group share. You replace in the balance sheet, in the consolidated balance sheet, the shareholders' equity by the debt you need to raise in order to buy the target. So I mean that I am used to adding all what we have on the same line. You see, this is the sum, but for the shareholders' equity, I do not want to include it in the sum. It's not because BNP Paribas is buying Société Générale, the shareholders' equity group share of which is 65.1, that the shareholders' equity group share of BNP Paribas will increase by 65.1. So for that reason, there is a column for restatements. And I'm going to say, I'm going to restate the 65.1. I mean that it is captured, this amount, 65.1, is captured in the sum, okay? But I want to neutralize. So I am saying minus, just in order to show that the shareholders' equity group share is unchanged at the end of the year. Having said that, there are other restatements to be done. I'm saying, well, shareholders' equity group share is restated. I did not include it. I did not include it. So if I did not include it, I am not going to say that I have inside this equity group share a dividend which will be paid out, because I have neutralized the shareholders' equity group share. So I do not have to deduct this minus 2.3. So I'm going to neutralize. I'm going to say, well, let's deduct this minus 2.3, which means that we add back 2.3. And then it means that the BNP Paribas consolidated common equity tier 1 is reduced only by the forecasted distribution of dividends by BNP Paribas, not by that of Société Générale. I mean that we deduct this amount, which is included in 122.5, but this amount was included in this amount, which is not taken into account. So I neutralize this restatement. And the very last important calculation we need to do for a bank, but also for a corporate entity, is the goodwill. Of course, there is a goodwill, of course, because there has been an active external growth along the past 25 years at BNP Paribas level, but also at Société Générale's level. So I'm not surprised to see that there is a goodwill inside the balance sheet of Société Générale, as inside the balance sheet of BNP Paribas. And I have to tell you that the goodwill is deducted from the common equity tier 1. I think, but I'm going to check, that I have already said it last time. I'm going to check right now. When I spoke about the common equity tier 1, when I spoke about the tangible book value, you see, I said it is a shareholders' equity group share minus intangible assets. I should have written it more properly, which I'm going to do immediately. Intangible assets and goodwill. Okay, so this is the first point. Okay, so I wanted to say that we deduct the goodwill, the existing goodwill, and also the goodwill which will be generated, if any, by the contemplated transaction. So, I would like to explain what the goodwill is and what the calculations we are doing consist in. So I'm going to come back for a few seconds or minutes on OneNote. And of course, as usual, I will also send this page. So I'm going to write down in black. Okay. And you can see in terms of organization of the paragraph that we were dealing with calculations of multiples. So let's see what it starts with. Solvency constraints, first point. Then peers approaches. Okay. And then we dealt with the DDM. Okay, so this was, if I may say, what was to be done for the valuation part. I'm going to come back to the syllabus so that it is easier for everybody to follow. Yes, it is. Just a second. So we will come back to the insurance company at the end of the course today or later at the beginning of next course. We are going to be now in the paragraph B, which is dedicated to M&A deals. Okay, so A was valuation and B is dedicated to M&A deals. So this is what I wanted to check. So again, I could have said A valuation. And now we are going to say that we enter into the paragraph B. Where is it? It's here now. Let's say that B will be dedicated to M&A deals. So what I want to say is that we need firstly to focus on the evolution of the common equity tier 1 ratio of the buyer. to do it. So this is the first point. We need to say that the common equity tier 1 ratio is made of Bayer's common equity tier 1 over Bayer's risk-weighted assets. I have to tell you that the buyer is undertaking the control of the target. The buyer will consolidate the target, and therefore it's risk-weighted assets. So I'm going to put a footnote or nota. The buyer, as the buyer, going to write more properly, is undertaking the control of the target, it will have, or it has, to consolidate fully the target, including its risk-weighted assets. So this is the first point, targets, risk-weighted assets. This is the first footnote. Second comment is that the purchaser or the buyer does not consolidate the target's equity, shareholders' equity. Yeah. Shareholders' equity group share. This is why I have restated it, which means that if the consolidated amounts are based on sums of corresponding amounts of the buyer and the target, the target's shareholders' equity group share has to be restated. So this is why I'm not going to add it. Third point, for any transaction, I'm going to write more properly. Between corporate entities or financial ones or financial institutions, as we are used to saying, calculation of a goodwill, GW 3.1. the goodwill is the purchase price minus the target's shareholders' equity group share. So this is the first point. The second point, we're going to calculate it in the coming seconds. The goodwill is booked on the asset side of the balance sheet. The third point is that from a solvency point of view, the goodwill is deducted from the common equity tier 1. And if you look at the figures which are available for Société Générale and BNP Paribas, you shouldn't be surprised by what I've just written down. So I said the goodwill is deducted from the common equity tier 1. It's on the asset side, and it is deducted. Well, you can see the goodwill. Here, it is indeed deducted. As you can see, the goodwill is deducted. This is what I wanted to say. So, BNP Paribas, as Société Générale, have performed M&A transactions in the past. They have booked goodwills. BNP Paribas has booked goodwills and also intangible assets for a consideration of 10.1 billion euros and Société Générale for a consideration of 5.2. But if there is a deal, we're going to calculate that. We have the market cap of Société Générale, 19. Which price will be paid? Not 19. I mean that you need to offer a premium over the market cap. And we are going to suppose that the premium over market cap to be offered to the shareholders of Société Générale is 30%, which means that we value Société Générale 30% above its market capitalization. We can see that. I'm going to reduce maybe the size of the columns again so that it's easier to see everything for you. I think it's too much. Just a second. Okay, just a bit more. Okay, so you can see that the valuation for the sake, that's going to do differently. Okay, I'm going to reduce this size. I'm going to reduce this size. I'm going just to. Okay, so you can see that the necessarily it's moving away. So I'm going to that way. Okay, so you can see that the valuation which is taken into account is 30% above the market cap. So if you have a market cap in blue of Société Générale for a consideration of 19 billion euros, if you add 30%, you multiply by 1 plus 30%, and you get 24.8. If you get 24.8, well, you can see that it is exactly the contrary to what I have let you imagine. I mean that the price is less than the shareholders' equity group share. So in that context, I'm not going to say it's a goodwill. A goodwill would have been created if the price to be paid, for example, 70 billion euros, would have been higher than the shareholders' equity group share, which is not the case. It's less. So if it's less, instead of speaking about a goodwill, at the contrary of good is bad, instead of booking a goodwill, we can say it's a negative goodwill, or we say, as already written down here in order to save time, we say it's a bad will for a consideration of 40.3. So there is an issue with that. There's an issue because you can say it's great news, very good news to have a bad will. I mean that I've taken into account the solvency regulation, that goodwills are reducing the common equity tier 1. Goodwills are deducted. So it means that algebraically, bad wills should increase the common equity tier 1. But we can't say that the full bad will increase the common equity tier 1. Because if we have here a bad will for a consideration of 40, which is a huge bad will, it's mainly because at the time of the figures you have here, Société Générale was still strongly involved in Russia, which means that the receivables, the commitments of Société Générale in Russia had to be written off at that time. And what was eventually decided with the buyer of Rosbank is not very clear. So at that time, we could say that there were commitments in Russia which would have to be written off for a consideration, as you can see, of about 18.6 billion euros. And for that part of the bad will, we can't create equity. I mean that part of the bad will is justified by the anticipation of the losses to be incurred because of the controlling stake in Rosbank in Russia, which means that we are going to recognize the bad will for a consideration corresponding to the difference between the bad will, which will be in the books, and the commitments in Russia. I mean that we could expect a loss for a consideration of 18.6. So the recognition of bad will in that context, it's an exceptional situation. I mean that you do not have a war in Europe every day, and you are not supposed to work on a target which is strongly involved in a country which has decided the war. So it's an exceptional situation. Okay, but it's really interesting to be able to work on Société Générale. This is why I took it into account. So it means that instead of saying, well, I'm going to have a positive impact because it's a bad will on the common equity tier 1 for consideration of 40.3, I'm going to have a positive impact only for consideration of 21.7, which means that it enables to balance all the existing goodwills. 22, let's say 22 is more than 15. So at the end of the day, I can also calculate the sum for the risk-weighted assets. I mean that I can add 714 at BNP Paribas level with 363 at Société Générale level, which means, as you can see, 1,077. And as we have the common equity tier 1, and as we have, as you can see here, the risk-weighted assets, we can divide common equity tier 1 over risk-weighted assets, and you have 9.4%. So it would really be an issue. I mean that nowadays we have for Société Générale a common equity tier 1 ratio, which is 12.9%, which would be reduced to 9.4%. But in counterpart of that, BNP Paribas would get the control of Société Générale and would get its future net income. We are not going to consider 2021 because it's the past. We are not going to consider 2022 because it is an exceptional year because of the war. We are going to consider either 2023 or 2024. And I think it will definitively be enough. So I'm going to stop having the link with the provider of financial information. First of all, I'm going to get rid of that. Okay. Will be better that way. Okay. So what I want to say, I'm just going to introduce and we'll terminate the calculation next time. It will take 10 or 15 minutes. I'm going to say that if we want to study M&A deal, just to terminate for today, okay, we focus firstly, which has already been done, on the evolution of the common equity tier 1 ratio of the buyer. And the second point, which will be easier to explain because you've already seen that in other courses, is that we need to focus on the buyer's EPS accretion, assuming this amount is positive, or dilution, assuming this amount is negative. I would like to remind you that the EPS accretion dilution is the buyer's EPS after the deal over the buyer's EPS before the deal. I'm going to write more properly. Minus 1. And I would like to remind you that the EPS is the net income over the total number of shares. So this is the calculation we will perform at the beginning of our next course. Of course, as I said, I'm going to put on Canva all what's been written down here, not much. I will also put that, many calculations which have been done today, and we'll do that in the coming seconds, just after the end of the course. And I will also provide, before our next course, the slides corresponding to the calculations regarding the DDM, which had been started last time and terminated today. So, having said that, I would like to know, before stopping the course, if you have any question. Are there questions on that? Either directly or by mail, as you want. But not by mail, by the chat, if I may say. No question? No question? Before stopping? Of course, you need time to digest. I would have said it. Okay, but I think that with the slides, it will be, I should say, relatively easy to digest. But of course, it takes time to review it and so on. So we're going to stop here. Okay. So we stop here, and I'm putting everything on the system. Thank you. Bye-bye. I'm going to upload what has to be uploaded immediately. Well, where is it? It's here. So files. Okay. So upload. Okay. So it will replace. Yes. And regarding this one, fichier exporter PDF. Okay, so where is it? Information and MNA. Okay. So upload.